Picture this. It's November 1923. You're standing in a bakery in Berlin. You can smell the fresh sourdough, but when you look at the price board, your stomach drops. A single loaf of bread is 200 billion marks. The woman in front of you didn't bring a purse. She's pushing a wheelbarrow full of cash just to buy a quart of milk. And here's the kicker. While you're waiting your turn, the baker walks over, crosses out the price, and writes 250 billion. Your money just lost 30% of its value in the 12 minutes you stood in line. This sounds like a Mad Max movie, right? It's not. It was the Weimar Republic. And it's happened in Venezuela, Zimbabwe, and Lebanon. It's the ultimate financial nightmare. Waking up to realize the paper in your wallet is better used as wallpaper than currency. My name is Max, and I spend way too much time thinking about economic autopsies and currency cycles. If you're someone who feels like your paycheck buys less every single month and you're worried the experts are missing something big, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Look, here's the thing. Historically, the average lifespan of a fiat currency is only 27 years. The US dollar has been unpegged from gold since 1971. Do the math. I'm not here to sell you a bunker. I'm here to show you the financial forensics of what actually holds value when the rules of money are rewritten overnight. Most people think of gold as a boomer investment. But when a currency collapses, gold isn't an investment. It's insurance. In Weimar Germany, if you held paper marks, you were wiped out 100%. If you held gold, you maintained your purchasing power entirely. An ounce of gold bought the same basket of goods before, during, and after the collapse. Here's what most people don't realize. Gold doesn't do anything. It doesn't have earnings or dividends, and that's exactly why it works. Governments can't print it. During the 2008 crisis, once the initial panic settled, gold rose 166% in 3 years. Silver did even better, jumping 448%. Even looking at more recent data, we see that in countries like Turkey, citizens doubled their gold deposits in a single year just to keep their heads above water. Now, you might be thinking, Max, I can't pay for gas with a gold bar. You're right. That's where foreign hard currency comes in. In 2019, a nurse in Lebanon had $50,000 in savings in a Lebanese bank. By 2025, that $50,000 was worth exactly $1,000 in purchasing power. She lost 98% of her life's work, while the nominal number in her account stayed the same. But her colleague, who kept US dollars in cash under a mattress, she kept 100% of her wealth. This is where it gets really interesting. The US dollar's share of global reserves is gradually shifting, but it still settles 50% of global payments. It's not about finding a perfect currency. It's about holding a currency that isn't the one currently on fire. This is totally counterintuitive, but look. Venezuela's stock market rose over 3,400% in 2024. You'd think an economy in a tailspin would kill stocks, right? No. A stock is ownership in real assets: factories, land, and equipment. If a company is worth $100 million and the currency devalues by 3 times, the stock price should theoretically triple just to keep pace. But here's the thing. Only companies with international revenue survive. If a company earns 100% of its money in a failing currency but has to buy parts in dollars, they're dead. If they export goods and receive dollars or euros, they thrive while their local costs, like labor, are inflated away. When the system freezes, economic activity doesn't stop. It just moves to the shadows. In post-World War II Germany, the official currency was so worthless people traded in cigarettes. Why? They're divisible, non-perishable, and everyone knows what they are. In modern Venezuela, fishermen traded fish for flour. This is where most people get caught off guard. Things like medical supplies, batteries, and even soap become money during a crisis. You can't build a retirement portfolio on aspirin, but you need a small tactical stash to handle the weeks when the ATMs go dark or the grid stays down during a bank holiday. Finally, we have the immobile store of value: land. During the Great Depression, farmers had a massive advantage. They could eat. Urban dwellers with rent-producing apartments were stuck with tenants who couldn't pay. Calories always beat paper rent in a crisis. However, and this is a big however, land has a major weakness. You can't move it. In Zimbabwe in 2000, the government simply revoked property rights and seized farms. If you own land, it needs to be in a jurisdiction with a strong rule of law. It's the ultimate long-game asset, but it's the hardest to protect from a desperate government. History is an autopsy, and the results are clear. Fixed income is a death trap. If you are a creditor to a failing state, holding their bonds or their high-yield savings accounts, you are the first to be wiped out. Currently, the US national debt is sitting at over $34 trillion. I'm not saying the dollar is dead tomorrow, but being a creditor to a government that prints money to pay the interest on its debt is a mathematical dead end. In every single collapse from Weimar to Zimbabwe, bondholders got 0%. Look, the patterns are mathematical and they are predictable. The lesson isn't to live in a bunker. The lesson is that genuine diversification means holding different forms of value: precious metals as insurance, foreign assets for currency risk, and productive companies that work globally. Don't wait until the baker is changing the price board. Go diversify your assets across different jurisdictions and classes today. If this forensic look at history gave you a new perspective, drop a helicopter emoji in the comments so I know you're paying attention. I read every single one. Stay smart, stay diversified. I'll see you in the next one.